As the tug of war with the market rages on between hard and soft landing, Fed pauses and hikes, we step back and consider the importance of looking smart versus being smart. So after a pretty bearish, dominantly bearish, in fact, historically in terms of sentiment of bears overriding the number of bulls, 2023 has brought us back to a little bit of a tug of war. What happens when these tug of wars take place is a lot of investors feel the need to make a call, AKA look smart, and they forget how and the importance of being smart. So we're gonna pull that apart a little bit this week. Point number one in terms of how to be smart instead of worrying about looking smart is remembering it's not about other people, and this has a few components. Number one, it is about your goals. I hear with some regularity people say, hey, my neighbor or this magazine article told me you need $2 million to retire. Maybe, but I don't know what you're hoping to accomplish, how much time you have left to try to accomplish it. This process of being an investor, of really looking at your financial plan, it's about your goals. Point number two, it's about your timelines and those of your family members, or again, the things you hope to achieve. And that all results in point number three, which is you and the story you're hoping to write is the benchmark. Trying to perform against any arbitrary benchmark, whether it's the S&P or the AG, is not the point. It's thinking about that LIVE acronym: liquidity, income, volatility, and expected return, and getting the right balance for you and making sure your plan and your portfolio is built and designed for that. That's what we're here to help with anytime. Point number two is being prepared to look dumb at times. This is just an unavoidable truth about investing for a few reasons. Number one is the old adage goes, the market will do what will ever hurt and or make look foolish the most investors at any given point in time. I tend to think that that's true. How can you then be smart at the risk of looking dumb? Well, number one is you have to be willing to go against the crowd. If you're gonna be someone who's buying low and selling high, whether that's through rebalancing or anything else, you're going to be doing the opposite of what everybody else thinks you should do. And so that's why having that process, particularly as it comes to rebalancing, is so important. But again, remember, it's not gonna feel, successful investing is rarely gonna feel good all the time. And in fact, it's actually going to feel and or look to you and maybe other people foolish in the moment. But again, over time, something that will help you, in fact, to bend smart. Point number three. You got to have a winning process. The winning process is really about 3 H's that I want you to try to remember. Number one is your happiness is not tied to how the stock market did over some arbitrary point of time. Remember, 50% of trading days are negative, a full third of months have been negative, and a quarter of years have been negative. Any one of those is unacceptable amounts of time for you to be unhappy because of what the stock market did over a given period of time. Key to that is the second H, which is know your history. So sounds awful, man, this market never works. Extend things out a bit, whether that's that day, the month, the year, you saw some improvement there. Go a little bit further, and a good knowledge of history helps you understand how the probabilities come back in your favor. This is where Matt's gonna throw a couple charts up over my face, 4 to be exact. Number one is if you just looked at stocks alone, if you extend that time horizon out to rolling periods of 5 years, your odds of being positive within your diversified basket of stocks is 90%. Get out to 6 years for the S&P and it leaps up to 95%. And as the second chart he's gonna put over, which is just a nice little line graph shows, you get back up to that 90, 95, 100 percentile pretty quick. So again, we don't have to and shouldn't be designing portfolios to work over just some set small period of time. If we give things time, the probabilities are going to shift into our favor. You improve your diversification, which is these next 2 charts. Add in something simple as the bond market. We would, of course, advocate for a lot more than just stocks and bonds. But in looking at these 2 charts, you can see how that 60-40 historically got you to a 90% probability of being positive. Over just 3 years, leaps to 95% somewhere between years 4 and 5. So again, knowing our history, knowing how to take those feelings in the moment, set them aside, and understand how time is on our side, and those probabilities will again work back in our favor. The third and final H, hold on, stay in the game. We talk about cash flow all the time because it is one of the key ways, whether it's a job and you're not yet retired, or income from the portfolio if you are in the distribution phase, to stay in the game, to not be a forced liquidator, to take what might be a tough moment in time for you or the markets, and again, let those probabilities come back in your favor. That's a huge part of diversification too. It's fun to be in the hot thing when it's hot. But if you're truly diversified, some part of your portfolio, by mathematical definition, should be disappointing you at any given point in time, whether it's not keeping up enough or maybe is even down. You want to have things that aren't all acting the same so that when you do get into a tough time for the stock market, there might be something else that's positive within your portfolio to pick on, or vice versa. Lastly is our mindsets. We need to remember as investors that while our moms love us and care about our feelings, markets don't. As I alluded to earlier, markets are going to do whatever is going to hurt the most people, surprise the most people. It's just how it is if, again, you're narrowing your focus, your time frame's too small, and not remembering your history and keeping that perspective wide. In summary, there is a path through, but that path is not about prediction. So as we are here in this tug of war between the Fed doing this, the economy hard, soft landing, all the analogies about planes and everything else that people are trying to make, just remember that none of them determine your success. One of the big things that does determine your success is, again, write your own story. Only worry about being smart and looking smart to yourself within that plan, not to others, will put you more times than not, for the reasons we talked about, on the right path. Pundits may get paid to look and sound smart. We only get paid as investors when we are, in fact, making smart decisions. But some of these simple rules can help take you a long way. If you've got other questions, of course, feel free to reach out anytime. Thanks so much.